Hello everyone, welcome to the Analyst classroom. Today we are going to learn about the financial reporting quality. So here is the list of topics that is covered in today's lecture. So let's start with the first one: the financial reporting quality versus the quality of the reported result. So the financial reporting quality refers to the characteristics of a firm's financial statement. The characteristics of the firm's financial statement. High quality financial reportings adheres to generally accepted accounting principle and is decision useful. Then the quality of reported results refers to the level and sustainability of firm's earning. Here it's a characteristics of firm's financial statements. Here it's the level of sustainability and refers to the level and sustainability of the firm's earning, cash flows, and balance sheet items. High quality earnings are high enough to provide the investor firm's investor with an adequate return and the sustainable future periods. Spectrum for assessing financial reporting quality. How would you assess the financial reporting quality? So here is the highest to lowest quality of the financial report. So highest is the reporting is compliant with the gap and is decision useful. Earnings are sustainable and are adequate. Then reporting is compliant and decision useful, but earning quality is low. Okay. Then third is the compliant but earning quality is low and reporting choices and estimates are biased. Okay. Then fourth is the compliant but earnings are actively managed. So here is the top four highest to lowest quality of the report. First is compliant, decision useful, and sustainable. Earnings are sustainable and adequate. Then comes the reporting is compliant and decision useful, but earnings are low. So compliant but earnings are not sustainable or adequate. Then comes the compliant but earnings are quality is low and reporting choices and estimates are biased. Fourth one is compliant with gap but earnings are actively managed. Then the fifth comes is not compliant but numbers are presented are based on the company's actual economic activity. The fifth one is the financial reporting is not compliant but the quality of the reported results are actual. Then the sixth is the reporting is not compliance and includes numbers that are fictitious and fraudulent. Sixth is the not compliant and not actual. Okay, so here is the highest to lowest quality of the financial reports. You might given the two or three uh, of these and could be asked to arrange these based on the quality of the financial reports. Okay, then comes the conservative versus aggressive accounting. So based on based on the choices that we that can be made within the gap include conservative and aggressive accounting. Conservative accounting choices tends to decrease the company's reported earnings and financial position, and the aggressive accounting choices tend to increase the reporting earning and improve the financial position. Okay, so conservative means it will reduce the profit and earnings, and aggressive means it will increase the profit. Okay. Then some managers employ conservative bias during the period when earnings are aggressive. During the poor period and below target earning to actual artificially smoothen the earning. So let's understand with the example what is the conservative and what is the aggressive accounting. So can be and how it smoothens the earning. So for example, here is the 1, 2, 3, 4 and 5. 5 years, and somehow managers know that these 1, 2, 3 years are will be good. These will be good years and these two are will be bad years. Okay. So here company will earns good profit, and here it will uh, not earns good profit. So what the manager does is that suppose I have a asset, and I should be amortize this in a straight line method of 20, 20, 20, 20 and 20. But what he actually do to smoothen the earning, he used the accelerated method of depreciating, double declining method. So what he does, he depreciate the asset over the 3 years entirely, and here it will not depreciate that. So what this will does it that the in the good time the profits are good, but it is showing the higher depreciation, so it profit will reduce slightly, and here its profit are low, but he will not uh, account for the depreciation any, so that its profit will show little higher due to this. So it will artificially smoothen the earning by using this depreciation. So here is the list of the actions that can be identified that it is the aggressive accounting or a conservative accounting. So in the aggressive accounting, capitalizing the current period's cost. If you capitalize the cost, then it will increase the profit. Longer estimate of the lives of the depreciable asset. Longer estimates mean lower depreciation, higher profit. Higher estimate of the salvage value. Higher estimate of the salvage value means lower depreciation, higher profit. Higher estimate of and then the straight line depreciation. Straight line method, lower depreciation, higher profit. Delayed recognition of the impairment. If you delay the recognition until you recognize the uh, recognition of the impairment, your profit will be higher. Less accrual of the reserve of bad debt. If you accrue less, if you show less accrual, your profit will be higher. Smaller valuation allowance on the deferred tax asset. If you show smaller valuation, your profit will be the higher. Then the conservative accounting, expensive current period cost. If you expense, profit will be low. Shorten estimate of the life of the depreciation asset, higher depreciation, lower profit. L- Lower estimate of the salvage value. Lower estimates mean higher depreciation. Accelerated depreciation, like we discussed the above. Then the early recognition of the impairment. Then more accrual of the reserve of the bad debt, and the larger valuation allowance on the deferred tax asset. Then comes the motivation that might cause the management to issue financial reports that are not high quality. What is the motivation that caused the management to issue the low quality reports? So, to issue low quality financial reports, they should be having the opportunity and motivation to do so, and they also should be have any rationalization to explain their action. So when these three comes, the have management issue low quality financial reports. Here is the motivation list that cause the management to issue low quality reports. Pressure to meet and exceed earning targets, career consideration, they can boost the earnings of their company, increase their compensation, improve perception of the firm among the customer and suppliers, meeting the terms of debt governance. Then the conditions are considered to issue low quality or even fraudulent reports. What is the condition? Conditions that are often present when managers issue low quality financial reports include motivation, opportunity, and rationalization. We discuss above the weak internal controls, inadequate oversight by the board of directors, wide range of acceptable accounting treatments among the factors that may cause the provide opportunity for low quality reporting. Then comes the mechanism that discipline the financial reporting quality that are potential limitation of those mechanism that helps to discipline the financial reporting quality includes the regulation, auditing, private contracts, regular typically required for public companies to provide periodic financial statements and notes, include management commentary, obtain independent audit. A clean audit opinion offers reasonable assurance that financial statements are free from material errors, but does not guarantee the absence of the error or fraud. The fact that the firms select and pay their auditors may limit the effectiveness of the auditing to discipline financial reporting quality. Then the presentation choice include non-GAAP measures that could be used to influence an analyst opinion. Firm may attempt to influence analyst valuation by presenting non-GAAP measures such as earnings that are exclude certain non-recurring items. IFRS required to firm define and explains the relevance of any non-GAAP measure and reconcile them with the most comparable IFRS measure. Similar requirement applies to US firm also. In the United States, companies that are report non-GAAP measures in their financial reports are required to display the most comparable comparable gap measure with equal prominence. Provide explanation by the management as why the non-GAAP measure is thought to be useful. Reconcile the difference between the non-GAAP measure and most comparable GAAP measure. Disclose the other purpose of for which the firm used the non-GAAP measure. Include any non-GAAP measure, any item that are likely to recur in the future, even though related are the non-recurring, unusual, infrequent in the financial statement. IFRS also required that firm using non-GAAP measure in the financial report must define and explain the relevance of the such report in non-GAAP measure. Reconcile the difference between the non-IFRS and the most comparable IFRS measure. Then the accounting method choices estimates that could be used to manage the earning, cash flow, and balance sheet items. What are the accounting methods that could be managed the financial reports? So revenue recognition choices such as shipping terms, accelerating shipments, and bill hold transaction. Estimates of the reserve of uncollectible accounts and warranty expenses. Valuation allowances on deferred tax asset. Depreciation methods. Estimate of useful life salvage value and the recognition of the impairment. Inventory cost flow method. Capitalization of expenses related party transaction are used to manage the earning, cash flow, and the balance sheet items. Then the last is the accounting no, accounting warning sign and the methods for detecting manipulation of information in financial reporting. Here is the warning signs. Revenue growth will shown as the out of line with the comparable firms, change in the revenue recognition method or lack of transparency about the revenue recognition. The receivable inventory and total asset ratio is decreasing over time. Bill and hold barter and related party transaction. Net income is not supported by the operating cash flow. Capitalizations decision depreciation method useful life salvage value out of line with the comparable firms. Fourth quarter earning patterns are not caused by the seasonality. Frequent appearance of the non-recurring items. Emphasis on non-GAAP measure minimum information and disclosure in the financial reports. These are the warning signs. So that's it. This is the readings of the financial reporting quality chapters. Thank you for listening. Have a good day.